Welcome back. I'm here with Philip Petursson, Chief Investment Strategist with IG Wealth Management. Philip, you did touch on this, and that's the household debt. Unaffordability is still a huge concern in Canada, and I think probably in the U.S. as well. Is that a near-term risk that you're paying attention to?
We are, and in fact, it's a greater risk in Canada than the United States. And that's because of the way our mortgage market works in Canada versus the US. In the US, it's very typical to have a 15-year or 30-year fixed rate mortgage. So, with the interest rate increases that we've seen in the United States, it's only impacting the new buyer. And in fact, what we're seeing is people in a home already, the existing home sales are actually falling because no one wants to unlock that mortgage at that very, very low rate they were able to achieve 3, 4 years ago. In Canada, it's different. The majority of our mortgage market is within a fixed term. And typically it's a 5-year fixed term. So we're just starting to see the impact of the rate increases in Canada on the mortgage borrowers. In that, if you assume 20% of all borrowers renew their mortgage each year, so it's 5 years spread out. We've seen, last year, so only a fraction or 20% of the 5-year terms come for renewal. Yes, they renewed at a higher rate, but we're yet to see the bulk of them really come over the course of the next year to 2 years. And the interest rate difference, we've calculated it on a mortgage today, a 5-year fixed today versus the expiring 5-year fixed, can be 35 to 40%. So it's quite significant. So we're just starting to see it. Anecdotally, you're hearing about it, word of mouth through friends and some of the changes on their payments. The housing market seems resilient, but I think we're seeing the numbers are a lot smaller. The values of the homes are going up again, but the number of homes being sold are far fewer than where we were 2 years ago. So you still have some buyers that can afford the current rates, but I think we're going to see greater pressure on those existing homeowners as they renew their mortgage this year and next.
Yeah, it really will be interesting to see how this unfolds because, I'm hearing anecdotally people are pulling their money out of retirement savings because no one, let's face it, no one wants to leave their home. They'll do anything to hang on to their house.
Exactly. So what's the consequence of that? The consequence is that these people will have to find the money elsewhere. So if you're drawing down your retirement savings, or what you're doing is reducing consumption in other areas. And so it's, hey, you're not going out to the restaurants, you're not going shopping as often as you did. Maybe you're not traveling as much as you did because you have to pay your mortgage. That's going to result in slower economic growth.
Okay, let's talk about the markets. What's your outlook for the TSX? I know that markets look ahead and are priced as such, but what are you seeing being reflected in our economic outlook?
Well, we've adjusted our outlook for the markets a little bit lower in the last quarter, and that's because of the softness that we're seeing in terms of oil prices and commodity prices in general. And it relates a little bit to the reopening of the Chinese economy that hasn't been as strong or as financially supported by the government in China as we thought it would be. And so that's resulting in a modest oil surplus globally, driving the price lower below $70, which is where we are today, driving the price of other commodities like copper lower. And that's a sign of one, a general economic slowdown globally, but two, what it means for the TSX is that the TSX is driven by commodity prices. When commodity prices are up, when oil's up, the TSX tends to do well, obviously, because of the weight that we have in the energy sector, in the material sector. So my outlook for the TSX is still positive, but it's a little bit more modest through this year than what we started the year at.
So where should Canadian investors who are looking to park their money, say for 3 to 5 years, put their money? What do you advise them to do?
Right. So 3 to 5 years, I think we remain balanced. I think the outlook we will have come through whatever economic weakness we're facing over the course of the next 3 to 5 years. The environment will be better. We'll probably see a resurgence of economic growth. But that's, again, some point over the course of the next 3 to 5 years. Over the next 12 months, we have some economic headwinds facing us. And so we've been recommending adding more to fixed income, trimming
Ah,
some of our equity weight, whether that be in the United States or now we're starting to trim Canada a little bit and add that to fixed income. So be overweight fixed income, underweight equities. The reason being is interest rates are higher than where they were 2 years ago. bond yields are much more attractive than where we were 2 years
I
ago,
was going to
and they
ask you whether you
provide
like bonds. Yeah.
we do, and they provide that downside protection that, yeah, would balance out some of that equity market volatility. That, there's no guarantee that we will see it, but at least I'm protecting myself and earning an attractive yield along the way.